Welcome back to Yahoo Finance Live. I'm Brian Sozzi in D.C. at the Goldman Sachs 10,000 Small Businesses Summit. And I have a very special guest here, Goldman Sachs Chairman and CEO, David Solomon. Good to see you.
Good to see you.
Didn't I just see you on an earnings call?
You did see me on an earnings call yesterday.
All right.
Well, you didn't see me. You heard me.
I heard you. Well, I'll take that as well. So really, the room is getting full out here in D.C. A lot of small business owners. Lots of things top of mind with them. I talked to one individual that was concerned about how to fire an employee. Another one is worried about inflation. What do you think the biggest challenges of small businesses are right now?
Well, small businesses have had big headwinds over the course of the last couple of years. The pandemic was very, very tough on small businesses. But I will say one of the reasons we've brought all these small businesses together is to give them an opportunity both to interact with each other, share experiences learned, but also to talk to their legislators about the support they need so that they can move their businesses forward. Small businesses are such an important part of the lifeblood of the American economy. Huge hirers, huge employers. There's no question, and we've been surveying them, that they're concerned about the chance of a recession, but they're also optimistic, and they're also looking for ways to continue to move forward. And I think there's some great messages while we're here in Washington about making sure we get appropriate access to credit and appropriate support to small businesses so they can continue to invest and continue to grow such a vibrant part of the U.S. economy.
You're right. Small business is very much the engine of this economy. Are they hunkering down?
Well, hunkering down, I think it's a little bit too big a generalization to say that all small businesses are hunkering down. I'd say all businesses, large and small, are being more cautious right now. There's more uncertainty around the economic trajectory of the country. Inflation is a big, big headwind, and it's a very, very tough headwind on small businesses. And so I think people are operating more cautiously, but I think people are watching, trying to figure out the trajectory of travel. People are investing in their businesses, trying to move forward, but I think with a little bit more caution.
I listened to your earnings call 3 times. That's just what I do. I had to do it. And
we have to find something better for you to do, because 3 times.
Yeah, get in line, David Solomon, because a lot of people tell me that.
Maybe a Netflix show or something after the first or second
time. Fair enough,
time.
okay. But I heard more caution in your voice than I heard 3 months ago. What made you say that?
Well, I think there is caution in my voice. I don't know on a relative basis to 3 months ago. I'd say 3 months ago I was pretty cautious too. We've had a bunch that's happened over the last 6 to 9 months as we exit the pandemic and we were starting to move forward. Obviously, the war in Ukraine was a big disruptor, but I've really seen, watched, and experienced through the eyes of our clients the growing imprint of inflation on the economic activity around the world. And it's a big headwind. And so I think that headwind creates caution. I think the path is uncertain. There are a lot of people speculating about a recession. There are a lot of people speculating about the trajectory of all this. What I'd say is I'm uncertain as to the trajectory of it all, but I know that the scenarios where we have a bumpy road ahead are certainly possible, and I think it's a time to be a little bit more cautious and really kind of tighten up and make sure that you're deploying your assets and your resources in places where they're very, very prudent decisions.
When does these double-digit gains, we're seeing inflation for many different items, when does that slow?
Well, it takes a while. Inflation is a hard thing to crack. I think the Fed's on it. They're starting to tighten monetary conditions. I think slowly we're starting to get some improvement in supply chains, but I think that's going to take some time. And so we've had a variety of real exogenous events from the pandemic and otherwise, the war, that have really kind of accelerated the inflationary environment. And it's going to take us a while, to get some real relief. But I'm hopeful that as we head through the rest of the year and into next year, we'll see a flattening out and ultimately a decline in inflation so we can get back to a more normal operating environment.
Has inflation become entrenched?
Well, I think right now, and I said this yesterday in my earnings call, that inflation is deeply entrenched. But that doesn't mean that we can't, through appropriate monetary actions, different policy actions, get back to a better place where things are more in balance. But at the moment, inflation is a big issue, and it's having a big economic impact on everyone. And in particular, it affects small businesses. It affects individuals across our country. And so we've got to really make sure we make the right policy decisions here to try to alleviate this economic headwind.
Is the right policy decision for the Fed, is that a 100 basis point move at their next meeting?
I won't speculate or predict a specific move, but economic conditions need to get tighter to break the back of inflation. And I think the Fed's focused on it, and they're moving in a direction, and hopefully we'll start to see, some balance in all of this as they move in that direction.
As we move to that tightening economic climate or backdrop from the Fed, do you see more market volatility?
I do see a little bit more market volatility, but I think the volatility, I think at this point the market is expecting, more aggressive tightening on the part of the Fed. I think where we have some volatility or softness in the market as we look forward is I think you've got to watch corporate earnings. And up to this point, corporate earnings have hung in reasonably well. But with a tightening economic environment, I think you're going to see more pressure on corporate earnings. And it's just math. If we kept the same earnings multiple on the S&P, but corporate earnings decreased by 10%, you can figure out what the market impact is. So I think the big thing to watch in the next 12 months is corporate earnings. If you're a student of history, anytime we've been in this kind of environment, a decline in corporate earnings lags and comes next. And that should put, that may put a little bit more pressure on stock markets.
When I'm not listening to your earnings calls 3 times, I'm reading all the economic research from your team, specifically Jan Hatzius. I believe he's at a 40% chance of a recession next year. Are you on board with that?
Jan, I think, is the best out there. He's an incredible economist, and his prediction, I believe, is a 30% chance of a recession this year. Or in the next 12 months, and a 50% chance of a recession in the next 24 months. And so, it's a data point. He's in the business of making predictions. I'm not in the business of making predictions, so we'll watch and see.
How do you plan to run Goldman Sachs differently into this tightening economic climate?
Well, we don't run Goldman Sachs differently, and I've been around in the business watching these economic scenarios for almost 40 years. I graduated from college in the early 80s, the last time we were coming out of a high inflation environment. We always run Goldman Sachs with a focus on our clients, trying to make sure we're getting our resources, our people, our capital, our financial resources directed at our clients. In an environment like this, we probably have to be a little bit more cautious with respect to the way we invest in the future and growing the franchise, but we always take a long-term view. We try to be very, very nimble and flexible. I think this environment demands that. And we'll stay focused on our clients. And we know if we do that, we do the right thing, we may see our business slow a little bit, but in the long run, we'll continue to perform. And that's where our focus is right now.
Do you see a spillover? So the economic climate overseas in Europe has really also taken a turn for the worse. Do you think that spills over to the U.S.?
Well, it's something I think you have to think about. I think the chance of a recession in Europe is certainly higher, given what's going on there economically and some of the policy decisions that have been made across the continent over the course of the last 5 to 10 years. A recession in Europe potentially knocks 1 percentage point off U.S. growth. And so we are globally connected. We do operate in a global ecosystem economically, and a slowdown in Europe will have an impact on the United States. That's something that I think our economists like Jan factor in, to their calculus when they're predicting the forward.
Maybe you could clear this up for us. I've seen some stories since the earnings report on hiring. Is there a hiring freeze at Goldman?
There is not a hiring freeze at Goldman,
okay.
And just to be candid, I was disappointed. I went back and you said you listened to the earnings call 3 times. Mm-hmm. I went back and listened to it a first time. I participated the first time, but I listened to it. Dennis Coleman, our CEO, appropriately said we're looking at all our resources around the firm, financial and otherwise, and we are slowing the pace of our hiring. So we've grown the firm enormously over the course of the last few years. We've done a significant amount of hiring. We had planned to do meaningful hiring in the back half of the year, and we're slowing it down, but we haven't frozen it. There's certainly places where we're investing, and we'll continue to make those investments. And he also mentioned that we have a performance evaluation process that we do every year at the end of the year. We skipped it in 2021 coming out of the pandemic, but we're always looking at the overall head count of the firm, and we usually call a few percent of the firm every year. That's been something we do, and we've done, the 20 some odd years I've been at the firm. We've always done that, and so we're going back to that, but there is no hiring freeze. But we're going to be more prudent and slow down our growth in this environment. So
you're bringing back that annual performance review. What do you think the results of that will be? Another, culling a percentage of the workforce?
We've always, it's one of the things that's important to understand about Goldman Sachs and the way we operate. It's a very performance-based culture. We're always looking to make sure that people that are performing in our organization don't hang around, because it prevents us from giving the opportunity to hire more people that can really perform and add. Remember, it's a professional services firm. It's a people organization. We just are starting this week 3,500 new analysts who are just out of undergraduate school, over 300,000 people.
Wow, I feel old.
Well, I am old. You might feel old, but I am old. Over 300,000 people applied for those jobs. And so we have this great talent ecosystem, and we always want to make sure we're making room for young, excited, energized talent, to come into the firm. Well, and so that's something we've always done. It's a return to normalcy for Goldman Sachs.
As a former analyst myself, and in the spirit of analysts, let me ask you two questions in one. Checking accounts, back half of the year, still rolling out?
Yes, that is our plan.
Okay, checking accounts, and then lastly, your 2024 targets that you put out Investor Day February, still on track?
Yes, and you heard me, since you listened to the earnings call 3 times, I said, I think twice in the earnings call, once in my script and once in a question, there's nothing about this environment that's changing our strategic plan for Goldman Sachs. We are continuing to invest in our core businesses, strengthen and grow these new platforms, which include transaction banking, asset management, wealth management, and our digital consumer bank, because we really think there's opportunity for us to diversify our revenue streams, have more fee income, more stable, predictable revenue base for the firm, and we think that will accrue in value to our shareholders. And so we're comfortable with those targets. They're 3-year targets. A lot of time between now and 2024. And we don't manage the firm on a quarter-to-quarter basis, but we feel very good about the strategy we've put in place, and we're going to continue to execute on it.
Any Netflix suggestions for me?
I was told, I don't know what's Netflix and what's not, but the two things that I've got a long trip. I'm going to Tokyo next week, and the two things that I was told to watch is one is called The Offer, which I think is about the making of The Godfather, and the other is called Severance. And so those are the next two things on my streaming list when I get around to it. But I'm a slow streamer.
Well, inflation, rate hikes, and market uncertainty are deepening recession fears. But Americans want to know, when will we see some relief? Well, Yahoo Finance's Brian Sozzi sat down with Goldman Sachs Chief U.S. Economist David Mericle to talk about the state of the economy. Take a listen.
Sure. We're seeing the economy decelerate pretty sharply. We've already seen in the first half of the year a major slowdown in growth on the back of diminishing fiscal support and the increase in inflation further eroding household income. In the back half of the year, I think we'll start to see the signs of the Fed's monetary policy tightening slow the economy. And as final demand slows, companies' demand for workers should slow as well. Now, at the moment, job openings are still extraordinarily high. So this is not going to happen overnight. It's going to take a little bit of time for weaker aggregate demand growth to translate to weaker demand for workers. But I think by Q3, by Q4, we will see a sharp slowdown in the monthly pace of hiring.
So if I have this right, you're in the back half of this year looking for 150,000 jobs per month, right, on average?
On average.
Okay. And then next year, 60,000 a month on average. Why that differential?
I think it's going to take a while because there is usually some momentum in hiring, and because the current job openings rate is so elevated that there's clearly a lot of pent-up demand for workers at a lot of companies. So that even as the pace of growth decelerates, even as companies become a little bit less optimistic about the outlook, there are still a decent number of positions they're going to want to fill. And so we think it'll be a gradual step down from hiring of about 350 to 400,000 workers per month in the payroll survey in recent months to maybe 200,000 a month in Q3, dipping perhaps below 100,000 by Q4 and slowing a little further next year as the level of job openings comes down and companies moderate their hiring plans.
Is it fair to say that layoffs increase inside of that framework?
Absolutely. I think the hard question is, how quickly will laid-off workers be able to find new jobs? We know that we need to reduce total labor demand substantially in order to get supply and demand in the labor market back in balance and calm wage growth and inflation. Now, it would be great if we could just push down job openings without pushing down employment, making more people unemployed and raising the risk that things snowball into a full-blown recession. In practice, the hard question will be that as inevitably we get both some reductions in job openings and some declines in employment, will those unemployed people flow into remaining job openings as quickly as they normally do? One of the key features of the pandemic is that for whatever reason, available workers and available jobs have not been matching at the usual rate. And I think a very hard but important question now is, will that situation change? If it does, then most of the reduction in labor demand would come from a harmless reduction in job openings. Our prospects for avoiding a recession would be much better. But if this shift out in the so-called beverage curve persists, if unemployed workers continue to have a harder than usual time finding those available jobs, then it means that as the Fed raises interest rates, as demand falls, as demand for workers falls, we're probably going to get, in that scenario, we would get a good bit of both, a reduction in the openings rate and a more harmful increase in the unemployment rate.
So if someone is laid off from their job over the next 12 months, how difficult will it be for them to find a job?
At the moment, workers say it is the easiest it's ever been in U.S. history to find a job. Now, my guess would be that that situation changes pretty quickly as the economy slows, as job openings come down. Job openings have already begun to come down over the last couple of months. These days, we don't have to wait around for the official JOLTS report from the government. We have a bunch of different high-frequency indicators from job openings websites. They show a decline in April and May and June. But the level is still very high, and I think it's going to be a while before job-finding prospects begin to deteriorate.
As an economist, and I want to get into your Fed work too as well, because it's really enjoyable. What are some of the best real-time indicators someone should be watching when, in this environment, up seems down and vice versa?
Sure. So, the big picture problem is we need to get inflation under control, and certainly there's, I think, a path there where an economy growing more slowly than it normally grows could allow supply to catch back up with demand, bring inflation down, not immediately, certainly not by the end of the year, probably not even within a year or a year and a half, but over the next few years. And so any progress we make in that direction is encouraging in the sense that it would suggest there is a non-recessionary solution to the inflation problem. Now, the single biggest thing that I've been looking at this year, and that I'm still watching, is wage growth. Does that overheated labor market translate to excessively or to a rate of wage growth that is just not compatible with the Fed's inflation target? Last year, that was absolutely the case. This year, we're seeing mixed signals, but certainly the average hourly earnings data seem to be decelerating, and that's providing a hopeful sign. The reason I focus on wage growth is it's important, it's genuinely uncertain, and I think we can learn something about it in the near term. I don't think it's realistic to expect inflation to decelerate back toward 2%, over the course of the next 3 to 6 months. We're still probably going to see some flow through from faster wage growth to factor service sector inflation. And while I think we will eventually see the end of supply chain disruptions cause some normalization of goods prices, that's not going to happen overnight either. The labor market, to me, is the big wild card where I think we might actually learn something compelling soon.
Let's humanize this a little bit more. The average American out there is seeing double-digit increases for stuff, deodorant, eggs, steak, chicken, you name it. When do those increases start to reverse? Is that a next year thing?
So in many cases in the goods sector, prices have risen a mile above the pre-pandemic trend. And that opens up the question of, well, to the extent that this just reflects shortages, we ran out of things like automobiles, and so people are bidding up the remaining supply that's available. Could it be the case that as supply comes back, as we transition from an economy of scarcity back to an economy of abundance, as competition kicks back in, we see prices coming down a little bit? I think for many durable goods, that is probably right. It does look like prices are well above normal levels, that can't just be explained by production costs, and that we are seeing genuine scarcity. That seems to be the most obvious reason for this. Now, we're not going to replenish our depleted auto stock in a short period of time. I think that's probably going to take a year to a year and a half at least. But as that process gets underway, yes, I think there is some scope for some prices on some items to come down. For everything else, I think the hope is simply that prices stop growing so quickly as demand decelerates and that imbalance between supply and demand, both for final consumer goods and in the labor market, starts to look a little bit less extreme.
Are you sold on a recession happening in the U.S. next year? And if you are, how deep?
I think for now, we are still on a narrow path to a soft landing. Now, getting this exactly right, we know is going to be very difficult. reducing demand just the right amount, reducing labor demand just the right amount, making sure that this process, through reduced consumer sentiment, reduced business sentiment, doesn't snowball and spiral into a full-blown recession. I think everybody agrees that's going to be challenging. For now, I would say we seem to be undergoing a deceleration, not a contraction in overall economic activity, and we seem to be seeing a healthy slowdown in the labor market that certainly, as of this point, has not overshot where we want to get to. So far, I think we're still on the right track. Of course, recession risk is much higher than in a generic, boring year when we didn't have all of these problems and a big inflation problem to worry about. And our recession odds are reflective of that. But
and what are they? What are your recession odds?
Our recession odds are 30% at a one-year horizon, just below 50% at a two-year horizon.
So your baseline is still soft landing?
Our baseline is still a soft landing at a two-year horizon. I would say, roughly even odds. Those odds are something like double or more than double what you would say what you would give in a typical year.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi, still at the Goldman Sachs 10,000 Small Businesses Summit in D.C. Joining me now is Jessica Johnson-Cope, Johnson Security Bureau President and Chair of 10,000 Small Businesses Voices. Good to see you here.
Thank you for having me, Brian. Great to see you as well.
Take us through your story. You are running a family business that's been around for some time. Amidst all these concerns about recession, inflation, what made you get into the family business?
So I took over my family's business. I represent the third generation of Johnsons keeping New York City safe. And my father was diagnosed with terminal cancer a few years ago. And shortly before he passed away, I joined him to help run the business. And I was expecting to have him for 2 years. That 2 years ended up only being 3 months. And so my brother and I had the dubious decision of whether or not we would cash in our chips and sell the business, or whether we would make a return on the investment for the 16 people who worked for us. And we realized that those 16 people were not just people by themselves, but they represented families. Families in the South Bronx, New York, the lowest economic congressional district in the country. And so we said, we try to make it work. And a few years after I took over the business, we were introduced to the Goldman Sachs 10,000 Small Businesses program. We were in the inaugural cohort at LaGuardia Community College in 2010. And we leveraged the experience and the lessons that we learned in the program to turn the business around. And this year we celebrate our 60th anniversary, providing security guard services across the New York metropolitan area.
Lots of focus and concern, like I just mentioned, on recession. Do you see those concerns playing out in your business?
Oh, definitely. I mean, as a small business owner, recession is real. Inflation is real. The supply chain challenges are real. And it's no different than what a large corporation would face. It's just that we may not always have the same resources. I'm glad to say that the folks that are gathered here for the 10,000 Small Businesses Summit, we are resilient. Many of us have experienced growth during the pandemic, and in spite of the financial challenges and the economic challenges, we have the tools to grow our business in spite of inflation and recession.
I imagine you are looking for a very specific candidate for a security guard. Are you having trouble finding that candidate?
I will say that in the past month or so, we've seen an increase of people coming to apply for jobs. So I think that there's a tremendous opportunity to bring people into the fold for not just my business, but other small businesses, especially when we look at what some of the larger corporations are doing. They're slowing down their velocity of hiring, or in some cases on the tech front, we see that there are many layoffs. So there are people that are available and eager to work. And I think people just need to understand that small businesses, you have great opportunities to not just grow, but to make an impact with whatever skill set you find. So yes, we are looking for people that have great character, that understand customer service, and that can deliver what our clients need. And many of our people stand in the stead and are representatives of who our clients are. So when you go into a bank or you go into a healthcare facility and you see a Johnson security guard, you don't see my brand, you see whatever brand you're going to patronize.
I talked to Goldman Sachs CEO David Solomon earlier on. He said small businesses want more from regulators. As a small business owner, what are some of the things you want our regulators in this country to be providing?
Well, we are excited because tomorrow is Advocacy Day, and we will be talking to over 400 elected officials about what federal elected officials can do to help small businesses. Number one is reauthorize the SBA. The Small Business Administration has not been reauthorized in over 20 years.
Where have these guys been?
they've been focused on other priorities.
Fair enough.
But we'll use our opportunity tomorrow to talk about our legislative priorities. So reauthorizing the SBA, making resources available for workforce development, providing access to capital to smaller businesses like ours. And those are some of the key things that we're looking at. Healthcare assistance as well as childcare assistance. I know that I've seen that many of the people that we've lost over the past 2 years have been women because they have to stay at home and care for their children, especially during the lockdown. So if we can get some childcare assistance, that would really help small businesses like mine.
Lastly, interest rates are going up in this economy. Are you finding it hard to get the capital you need?
So capital is always a challenge. I think we need to be creative, but as I mentioned, we are resilient. So as entrepreneurs, we figure it out. So if it's not getting access to capital from a traditional bank, it's going to a CDFI or trying to find some way to negotiate lower rates, lower financing terms, faster payment terms from our clients, especially the large corporations. So we'll figure it out even if we can't get the traditional capital that we need to grow.
Joining me now is Rebecca Minkoff, founder and chief creative officer of Rebecca Minkoff. Rebecca, good to see you again.
Thanks for having me.
This is quite the event here Goldman Sachs put on with small businesses. What are you hearing from the folks at the event?
You know what? Everyone is preparing. Like, we all just got through the pandemic, and it's like, there's a recession. What am I going to do now? And I think it's on everyone's top of mind is, I just got through this. I thought we were in the clear, and here we go again.
It's from crises to crises, right? That's a good way of putting it. What should a small business owner be doing now?
I think that they should be assessing where they can save money. What is their core business that they can focus on and hone in on? You know, sometimes it's like a goldfish where everyone wants to have lots of products. What is the thing that everyone's going to need from you when they're saying, do I buy a coffee or do I get the muffin? And what is that thing that you could provide to them that provides value and really utility for people, especially right now?
You're a business owner. What are you seeing in your business in this environment?
So we're seeing a shift away from shoulder bags to crossbodies. But I think, again, people are asking the question, do I need that $8,000 bag right now? No, now is probably not the right time. Let me invest in a beautiful bag that is, you know, I can't even do the math, but less than an eighth of the price, 1/16 of the price, and have something beautiful and still go to the tank and fill up.
Does fears of a recession change how you design products?
It just makes me expand the price offering. You know, we've lived through the 2008, 2009 recession. How we got through it was we lowered our prices by almost 50%. And so that fundamentally changed our business. So us going through a recession, I'm like, I've been there, done that, I know what to do. Let me make sure that categorically I'm covering on, you know, people that are being hit hard and how we can provide something really of value to them during this time.
That was a tough time, the Great Recession. I certainly lived through it as well. Does it feel like we're in that environment again?
Not yet, but I think the murmuring, the grumblings, I think I worry it's coming, and I'm hoping that people are, you know, preparing for it.
People are returning to work. What are they shopping for?
Oh my gosh. Well, of course they're shopping for my handbags, but it's been a long time that people, you know, wearing heels, right? And so I think as they're going back in the office, it's out of the sneakers and back into some beautiful shoes.
Colors.
You
Are
know,
they in?
Colors are very in. I think it's a very easy, no-brainer way to show off something that makes people happy. And so we do sell a lot of color. Black is still our #1 style, though.
Black, okay, #1 style. Can you get the goods you need? You know, I talk to a lot of retailers, and they have had to just redesign how they make garments because they can't get the supplies that they used to been able to get to.
Yeah, so we had 0 supply chain issues, I was happy
Zero.
to say, until
Okay.
October of last year.
Gotcha.
And then it all fell apart. And we had an incredibly difficult time getting our bags. And so we just had to hold hands with our partners and say, you know what, spring this season, it's going to be summer. Summer is going to be fall, and we're all just going to hold hands and figure it out. And so I think we have great partners that have been nimble with us. Nordstrom, Saks, Bloomingdale's, Neiman Marcus. They've all worked incredibly hard to deal with not only delays on our end, but all designers. And so I think we just take it one day at a time, and what can we get and where can it go?
Does it feel like a very discount-friendly environment right now?
people want discounts for sure, especially right now, but that's not new. I think when you saw the rise of online sample sales and discounting, that was something that was started that was incredibly hard to go back from, but we've made a very conscious effort to, yes, we have our sales, they're at certain times of year and the customer knows when that is, and that's very normal for our industry.
Your expectations for the holiday season. Retailers are always looking forward to the holidays.
It's going to be a great time. I mean, you see travel is up, right, way past pre-pandemic levels, and I think the holiday is that time period where certain people were saying, don't travel, don't see your family, don't do anything, which was wrong. And I think you're going to see people say, enough is enough. I'm going to go be with loved ones. I'm going to buy them gifts, maybe be a little bit more thoughtful about how much you're spending, but definitely I think it's going to be great for retail.
All right, we'll leave it there. Rebecca Minkoff, good to see you. Enjoy the rest of this conference. We'll talk to you soon.
Thank you.
Companies are still feeling the fallout of the COVID-19 pandemic with a lineup of challenges now including a potential recession. But one headwind not in the headlines is a toxic work culture. I spoke with Adam Grant, an organizational psychologist and author of Think Again, he was able to shed light on this work culture. Take a listen.
I don't think we should eliminate offices altogether, but I think the evidence is really clear that as long as people show up half the week, they can work from anywhere the other half, and they're more productive, more satisfied, more likely to stay. There are no known costs to collaboration or relationships. So I don't know why we're so eager to have everybody on site all the time, but I think it's something we need to rethink.
So hybrid's the future.
I think hybrid is the present, actually, also. There are a lot of companies that committed to return to office and then doubled back and said, wait a minute, this is not working for us. Let's agree on a 2 or 3 day plan.
Toxic. That's a strong word. What is making the environment toxic right now?
So there's a great study that Donald Sell just finished with his colleagues where he looked at 5 attributes of toxic culture. And they break down to disrespect, exclusion, abuse, selfish and unethical behavior, and some kind of cutthroat or lack of inclusion tendency. And I think that fundamentally, this is not necessarily perpetrated by the majority of people, but we know empirically that bad is stronger than good. So all it takes is 1 or 2 leaders who don't necessarily care about other people or may not be thinking about the long term to begin to undermine a culture. And I think sadly, those leaders are often the ones that get ahead.
Is this, at this moment in time, look, we're still dealing with the COVID-19 pandemic. Now we have folks worried about a recession and layoffs. Is this the most toxic culture you've ever seen inside corporate America?
I think I've seen worse, but I've seen some really terrible moments, I guess, but also some really encouraging ones, right? I saw a manager not too long ago say, look, it's okay to call in sick. It's also okay to call in sad. And what I thought was powerful about that message was not the idea that we're going to give you 5 sad days a year, and that if you don't use them up by December, they're gone, right? It was the thought that we need to normalize mental health as part of health, and that just as you would take some time for yourself if you broke your leg or you got long COVID, that if you're burned out, if you're languishing, if you're depressed or anxious, we want to try to take care of you. And I think one of the few silver linings of the pandemic is that more people at a leadership and management level are starting to recognize that if you do not care about people's quality of life, you don't get quality work.
If you're a leader, how do you spot these toxic behaviors in the workplace?
Well, I think the first thing to do is to recognize that the people often have a hard time speaking up. So your job is to create an environment of what Amy Edmondson has called psychological safety, which is the sense that I could take a risk without being punished. And one of the ways that a lot of leaders try to do that is they say, hey, if you see any concerns or issues, please let me know. It's like in an airport, see something, say something. What I found in my recent research is that's not enough. Because when I say, hey, let me know if you see a problem, you don't know how I'm going to respond to that problem. I might bite your head off, I might ignore you, or I might address it. What I found is much more effective is to actually go the extra step and talk about the problems that you see. So if I say, here are some maybe cultural shortcomings that I think we might want to work on, what do you think of these? I'm not just claiming that I'm open to feedback, I'm actually proving that I can take it.
What is the impact? I mentioned earlier we're now looking at down the barrel of a potential recession here. What impact psychologically is that having on the workforce?
Well, we know that when people face recessions, they tend to fall into a threat rigidity response. They focus narrowly on trying to protect their jobs instead of broadly on trying to help their organizations flourish. And I think this is a good moment to say when things get really difficult, we've got to ask, what if What if we were in a situation where our company couldn't survive? There's a great exercise that I saw a consultant, Lisa Bodell, do called Kill the Company, where she likes to take management teams and ask them to try to put their own company out of business. I have to tell you, I've never seen a more energized group of executives in my life, right, than when we go through that. But what's so interesting is people come out of that exercise and they're much more creative on offense than defense. If you run Save the Company, you get a bunch of boring, conventional ideas. Whereas Kill the Company, people drill into possibilities they never would have voiced otherwise. And the psychological safety is built in there, right? When my job is to put the company out of business, there is no problem that's unsafe for me to voice. And so I think a recession, is obviously a threat. It's also an opportunity to reconsider some of your best practices that were built for a world that just does not exist anymore.
Is there a way, there are people watching this probably likely concerned about their own jobs, is there a way for them to recession-proof their own selves?
Well, I think there's a little bit of the COVID effect that's already added some recession-proofing, right? Which is it's easier to get a job anywhere than it was before now that so many companies are doing hybrid and remote work. So I think being open to working outside your location is something we should all be aware of. I think the other thing I would say in terms of recession-proofing is if you look at the values that companies are putting on the table for job descriptions right now, we have a huge premium on soft skills. So the most sought-after skill right now is actually the ability to communicate. And I think the sad reality is that a lot of people don't know how to showcase that. First thing I would do is I would say, okay, sit down and rewrite your resume and your LinkedIn profile to show that you can communicate in a way that makes you stand out. And I think it's a great opportunity then to not only attract interest from outside, but also remind your existing employer of what you bring to the table.
Tech valuations have been hammered as the bear market rages on, and that includes valuations for private companies such as Klarna. Yahoo Finance's Brian Sozzi spoke with prominent fintech exec Jackie Reeses about the outlook for the sector. Reeses also sits on the boards of Affirm, Endeavor, and Nubank. Take a listen to what he had to say.
The one thing, if you're a small business, you need to pay attention to is preparing for when things go sideways or south. And so there are two things that I would recommend a small business do. One, do the financial prep now. Make sure you run through downside scenarios so that you understand where you have weaknesses. Make cuts, make adjustments, do what you have to do, but be well planned. The second thing you should do is make sure you get access to financing now when you don't need it. The best thing you could do is have credit availability, either through online technology tools or through a traditional lender. And so I would advise small businesses to go out, look for financing, make sure they know what all their options are, and be prepared.
How would you compare the funding or access to capital environment today compared to the last recession?
Well, the last recession was more of a debt crisis than today. It's more of an inflationary crisis. And so we've got very different dynamics today. And so the challenge facing small businesses today is that around cost inflation. So cost of staff, cost of goods, supply chain challenges. And all of that means that there's cash flow challenges, that small businesses need to be more vigilant than ever in managing their cash flow.
Is the economy going south?
Well, today we've got incredible jobs numbers from last week. We've got great employment numbers overall, but there's a lot of challenges looking forward in terms of dealing with supply cycle challenges associated with the Ukraine war, associated with continued inflation. And so I think there's a lot of economic uncertainty that's plaguing companies. And so if you're not feeling it today, and we're starting to see some of the numbers come in a little lighter than expected in terms of consensus guidance on U.S. public companies, then you should at least be prepared for it, because a lot of folks would say that we are coming into a more challenging economic time.
And Jackie's modest here. She's also on the boards of Affirm, Endeavor, and Nubank, right?
Absolutely.
So let's step back from that. What would you say is the mood in fintech at this moment in time? We've seen valuations come back a lot. There's concerns about there and potential consolidations. How do you see it?
Well, if you look across fintech, there's been significant dislocation in the public markets, and companies have a reset in their market multiples. It's been fairly significant since the first sign of inflation mid-November at the end of last year. And so whenever you have a reset around rates going up, you're going to see companies like fintech companies be impacted by that from a market multiple point of view. Now what you're also starting to see is the dislocation hitting private companies, and you're seeing very large resets in valuation on the private side as well. Despite that, there's still incredible companies in the fintech sector that are seeing incredible strong growth today, even with some of the challenges in today's market environment.
The down rounds have been remarkable. What's the end game here?
Well, the end game is that great companies will continue to thrive. And so their revenue growth and their profitability might take a longer journey than a straight line up to the right. But companies that are great companies, like many of the public fintechs, will continue to thrive in any environment because their businesses are in many cases, incredibly impressive, strong, resilient companies. So I'm expecting there to be haves and have-nots. The haves, some of these bigger public fintech companies, I would expect to see do quite well through this environment.
Do they become consolidators?
They could. Yeah. They could. In fintech, you haven't seen a huge number of companies be strong consolidators. You're starting to see some more of it as of the end of last year. There's certainly a lot of folks sniffing around, even traditional companies starting to look at some of the fintech companies where the valuations have really put them in a place that they could be consolidated. And so that gives more traditional companies an opportunity to look around at technology opportunities that they didn't have before.
Do you think we are near a valuation bottom? Because I'm thinking about all the discussions I've had at this event, and it's clear that rates are going up, and they might be going up more dramatically. Does that cause another reset in fintech?
Well, I think the next 6 months is going to be a really challenging time. And I suspect we're at the bottom, but I'm also seeing some continued challenging times on the horizon around supply chain, around oil and gas. And so with that, I think it's going to be a rocky road for the next 6 months.
Lastly, you've had a really interesting career. What made you get involved in fintech?
I've spent my entire career in financial services creating esoteric financial products. And so whether that be in the context of a private equity firm or in the context of a company like Square, where I worked up until a year ago, it's still a place where you can create products that are new to financial services to help, bring more people into the aperture of the system and change the way finance is done. It's one of the biggest market cap sectors in the U.S. economy, and it's also one of the oldest, which means that there's plenty of room to make changes that could change business and consumer lives.